हेलो, गुड मॉर्निंग, गुड इवनिंग, सॉरी, गुड इवनिंग। मैं अभी भी गुड मॉर्निंग ही चल रही हूँ। लेक्चर सुबह होते हैं ना ज़्यादा करके, तो गुड मॉर्निंग बोलने की आदत पड़ जाती है। गुड इवनिंग तो यूट्यूब पे ही होता है। एवरीबडी, कैन यू हियर मी प्रॉपरली? स्टार्ट कर दे, बिकॉज पोर्शन इज मतलब बहुत ज़्यादा तो नहीं है। इट्स नॉट लाइक टू मच, लाइक मे बी काइंड ऑफ व्हाट 20 pages odd. Okay, okay. I think the students are already there, and we can start for that matter. So, guys, we can start with single index model. So maybe like kind of this 2 3 topics are not really like too much. I need to explain because it's a practical part only. Chandan Singh, जब जागो तब सवेरा. Yes, that's correct actually. Okay, great. चलो start करते. ज़्यादा let's not waste time, and we can talk like after the lecture maybe, because there is a good portion that we need to cover, and you can get good questions from this topic because there is something has been added in this topic. They are talking about gold. In the previous SFM module, they were not talking about gold at all. Okay, so alternative investments part is something like we can focus on in today's lecture actually, and that's why I fragmented the topic into two. Okay, chalo start. So just listen to me. What is a single index model? I will not get into the technical detail of the topic because that's a part of the practical part. But it's still, I feel that since it is coming in my way, I would not go like that only. So RE is equal to alpha plus beta into RM. Okay. Or you can say Y is equal to alpha plus beta X. Okay. Where Y stands for stock return, Y stands for stock return, and X stands for market return quickly. Okay. Now, what do you mean by this? So basically what single index model has been developed by William Sharpe. थोड़ी देर बोर लगेगा तुमको, पहले ही बोल देती हूँ, बिकॉज पढ़ाई कभी भी बहुत इंटरेस्टिंग नहीं होती है। समझ में आ रही है बात? और अगर सामने वाला अच्छा पढ़ा रहा हो ना तो और भी इंटरेस्टिंग नहीं होती है, ये भी ध्यान रख लेना। अगर बातें चल रही हो ना इधर उधर की तो ज़्यादा अच्छा लगता है सुनने में, हर किसी के साथ वही सेम बातें हैं। लेकिन मुद्दा यहाँ पे ये है, हिंदी बोल रही हूँ, मुद्दा यहाँ पे कि पेपर में इधर उधर की बातें आएंगी ही नहीं, ना मस्ती मजाक आएगा, आएगा ये जो कि हमको पढ़ना पड़ेगा। एंड दिस इज नॉट इंटरेस्टिंग, बिलीव मी, इट इज नॉट इंटरेस्टिंग। ओके, दिस टेक्स सम एफर्ट। अगर ऐसा होता ना कि अगर बहुत आसान या इंटरेस्टिंग होता तो दुनिया का हर आदमी कर लिया होता। और मैं गुस्से से नहीं बोल रही, अच्छे से बोल रही हूँ। ओके, तो अगर तुमको लगा रहे यार बोर हो रहा है, तो बोर ये ना मतलब चलेगा नहीं एग्जाम पॉइंट ऑफ व्यू से, तुमको पढ़ना ही पड़ेगा, चॉइस नहीं हमारे पास में, मेरे पास भी नहीं, तुम्हारे पास भी नहीं। ठीक है, चलो स्टार्ट। सो व्हाट इज सिंगल इंडेक्स मॉडल? सो दिस इज अ इक्वेशन. ओके, दिस इक्वेशन सेज रिटर्न ऑन द स्टॉक वाई is dependent on market. Okay, dependent on market. Okay, so this part is called, means y is generating returns, or detail में जाती हूँ. So there are two variables, one is dependent, one is independent. The dependent variable is the stock return and the independent variable is the market. Okay, that means if I am listed in the stock market, the changes which happen are because of the market. Okay, so beta x means that component of y that is because of market. For example, a stock is giving a return of 22%. Okay, and if you do 1.5, suppose the beta of the stock is 1.5. Okay, 1.5, and the market return is suppose 10. So into 10 that becomes 15. So how would you calculate alpha? So 22 minus 15 will give you, wait a minute, 22 minus 15 will give you 7%. That means this alpha 7% is unexplained, means the return component of the stock which is not because of the market. That means to say, if you understand my language properly, this is a single index model developed by William Sharpe, wherein he has developed a very simple equation where the stock is a dependent variable and market is an independent variable. A stock return is dependent on market, so you relate both of them with the help of a variable called beta. Okay, that measures the sensitivity of the stock return to market. So basically we can say that that component of a stock return which is because of the market is beta into X. Okay, alpha is unexplained, any reason it can be the return component of the stock because of not because of the market. That's how we explain it. Okay. Okay, thank you. अरे नहीं, मेरी आवाज़ बहुत अच्छी थी, पता है तुम्हें, मेरी आवाज़ बहुत अच्छी थी, लेकिन क्या हो गया ना कि पढ़ा पढ़ा के काइंड ऑफ बिकॉज ऑफ सो मच ऑफ टीचिंग, आई एम टीचिंग सिंस 17 ईयर्स, 17 साल हो गए. ओके, तो मैं खुद की अभी आवाज़ नहीं पहचानती हूँ. इतना बोलना है, बोलने का ही तो काम है, बोलने के ही पैसे मिलते हैं हमें तो, राइट. तो बोल बोल के आवाज़ मेरी पूरी बदल गई है. मेरी आवाज़ सुरीली थी थोड़ी, अभी थोड़ी मोटी हो गई है, बट ठीक है, स्टिल इट्स अ कॉम्प्लीमेंट फॉर मी बिकॉज शी इज़ अ वेरी गुड एक्ट्रेस एक्चुअली. थैंक यू रिया. देखो बच्चे बीच बीच में ऐसे बोलते हैं तो लाइव बैच में क्या है ना, समय पास हो जाता है, वरना हमें भी बोर होता है भाई. Okay, start. So basically I will read this. So this equation is given. Quickly let's move on. I'll try to focus on that part which is theory component actually. So this is the equation. Okay. Now from this equation only, I told you in the last lecture, total risk is equal to systematic risk plus unsystematic risk. So total risk of the portfolio is beta square P sigma square X plus sigma square E. So this part, I'm not getting into the detailing guys because you know it is a theory lecture. So this part is systematic risk and this part is unsystematic risk. And this is sigma square P is basically variance of the portfolio. If you take a root, then it will give you sigma P. So there are basically two formulas. लेकिन मेरे से ना I just cannot like help myself. I get into, मैं खुद ही जा करके कुएं में कूद जाती हूँ, मैं खुद ही ट्रबल में अपने लिए बुलाती हूँ. I just cannot help explaining to the students actually. So there are two formulas of sigma P. Do not forget that. Sigma P as per Harry-Markowitz model, that is W square A sigma square A plus so on. And this is sigma P which is root of beta square P sigma square X plus sigma square E. So basically, if they give you, careful, if they give you a relationship between two stocks, that means you will use this formula. If they give you relationship between stock and market, which is beta, then you will use this formula. Okay, so we know only two formulas to calculate sigma P. One is the Harry-Markowitz model and one is the William Sharp model. Guys, they will not ask you theory on this part. I can only help you telling a few things which you might not know at this point of time, or maybe somebody has not told you. So I just thought that I might help you because students do ask, how do I come to know which formula of sigma P I have to use, Harry-Markowitz or William Sharp? So because William Sharp did not talk about relationship between the stocks, covariance between stock A, stock B. He talked about market. Harry-Markowitz never talked about market. So if you have something which talks about market, then it has to be the second formula. Okay, that way. So this is done. This is your systematic risk. I'm not getting into that. You already know this. Please, if you have any doubt with respect to any calculation part also, it's okay. Wherever you have studied from, it is completely fine. Put in the YouTube comment box. I will definitely reach you out. Share your email ID if possible, or maybe like whatever. Or maybe you can ask on the Telegram also, okay, ma'am, I do not understand this concept. Please help me. So I will not ask you whether you have taken lectures from us or not. I'm not going to ask you. For me, if you're asking a doubt, you are a student for me. So, but here I think we should not focus on the the calculation part of the portion. AFM is majorly like the practical part. Okay, theory is, I'm just trying to help you that so that you are not missing out on the theory, then the MCQs and the case studies. So it's a very intricate calculation. You can definitely ask me a doubt if you have. Put it on my Telegram group. It is completely okay. I'll definitely answer on that. Chalega. Done. So capital asset pricing model, quickly guys. So in this whole paragraph, I'm not going to read for you, but I will tell you what have they written there. So basically they have told that, see, this is not too relevant actually. This paragraph is not very relevant. What is relevant is assumptions, some of the assumptions of CAPM, which they can definitely give you in the case study also or in the theory question also. State the assumptions of CAPM. So we'll come to that and we'll do it properly. But definitely if there is something written, then I have to make you comfortable. So what are they writing here? So CAPM model, listen to me carefully now, okay? It is not important that you should like be able to recall, but सुनोगे तो अच्छा रहेगा मेरे लिए तो क्या लिखा है वो सुन लो खाली, और क्या होता है वो सुन लो. So basically CAPM model, full form capital asset pricing model. So till the time William Sharpe gave that equation, RE equal to RF plus RM minus RF into beta in 1980s somewhere, and for that CAPM model he won the Nobel Prize also. You should be aware of that. So before that, for example, if I ask you to invest in my company, please invest in my company in the form of equity, won't you ask me, ma'am, how much return will you give? I don't know how much return because I have not done that business before. So what is there any way with the help of which I can calculate that return and tell to you? Yes, there is actually. So that is why capital asset pricing model, when I say capital asset pricing model, I'm not trying to say rupees 100, $100, rupees 200 and all that. No, I'm not trying to say. I am trying to compute for you what should be the return expected from any asset. That asset can be a financial asset like equity. Okay, before William Sharpe gave this model, there was no model existing out there with the help of which any investor could have been able to calculate what is the return that I can get from a particular investment. And that is why CAPM model became very, very popular. After CAPM model, many models came like multi-factor model, APT model and all that, and they gained a lot of popularity. But then the base is CAPM model. This is whatever I just spoke was from my side. It is not written here. Okay, what they are writing is that in the Harry Markowitz model, okay, the modern portfolio theory by Harry, and let me tell you, Harry Markowitz was the guru of William Sharpe. William Sharpe used to be a student of Harry Markowitz, and William Sharpe is still alive. Okay, and he studied with him. If you would have done my live lectures or recorded lectures, whatever, I have told a lot of things that I have studied about both of them, you know, but at this point of time I can't share too much of things because we are running short of time. Okay, now, so basically guys, what is given in the paragraph, the ICI module, they are writing that Harry Markowitz focused a lot on the risk management, quantification of risk and management of risk. Fine, one statement. Second statement, they say that the individual risk of an individual investment and portfolio risk are two different things. This is a very nice thing that I have seen, that I came across actually in this. So in risk of a security and risk of a portfolio are two different things. So risk of a portfolio can be systematic and unsystematic, okay, and unsystematic risk can be completely diversified away. As per William Sharpe, be very careful on the fact that Harry Markowitz did not segregate risk into two parts, systematic and unsystematic. No, he did not. Okay, but William Sharpe did. He said risk, the total risk, the variance, the SD can be divided into two parts. One part is systematic, one part is unsystematic. Okay, an investor should not be asking any return for unsystematic risk or diversifiable risk because it can be completely eliminated from the portfolio. An investor should get compensation in the form of return only for taking systematic risk because that risk cannot be diversified away. For example, interest rate risk, inflation risk, GDP growth rate risk, fiscal monetary deficit, balance of payments, and so many things, political stability, international, global, and geopolitical situation, everything. You can't control, I can't control, companies can't control, businesses can't control that. So that risk is something, if I'm an investor, when I buy a stock, when I invest in a company, when I invest in a portfolio, that risk I can't control because businesses also they can't do anything about that. And definitely an investor should be getting return for having systematic risk, but they should not get any return in the form of for assuming unsystematic risk. अगर उसने unsystematic risk अपने portfolio में रखा है तो ये उसकी गलती है, हमारी गलती नहीं कि तुम return क्यों मांग रहे हो, तुमको मिलना ही नहीं चाहिए. So basically I will write something here which makes it easy for you. This whole paragraph is talking about risk of a risk of a security versus risk of a portfolio. Okay, so just try to, and this can be divided into systematic and unsystematic. Okay, this can be diversified away. Okay, so you get just write down all this. We just can't like. Okay, now, so going ahead, I'm sure you understood what I just said. And guys, the lecture is on the YouTube. You can always revise, kind of any which ways. All the students put me on 1.5 speed and they listen the lectures. In the practical, they say, ma'am, you go very slow. But it is intentionally designed that I go slow, because not very slow. Prashant is my live student only, he can tell you. I don't go very slow. But yeah, the problem is that if I am teaching in a normal speed, okay, if I teach in a normal speed, you can always increase my speed if you do not like my speed of teaching. Like if you think that ma'am is going too slow, I want it fast. But if I teach very fast, a student cannot like make me slow. फिर जैसे तुम्हारे स्लो मोशन चलता था ना पुरानी हिंदी मूवीज में, ऐसे 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 करके वैसा हो जाएगा, फिर वो कितना गंदा लगेगा देखने में. इसलिए स्पीड में डिजाइन तरीके से उसको नॉर्मल रखती हूँ. तुमको इंक्रीज करना है, तुम कर लो. Okay, start. So assumptions of CAPM. This is something that you should definitely be, it's an important topic actually. Okay, so efficient market. Listen, don't look what is given in the book. Look at what I'm writing, because that will help you remember. Efficient market. I'll speak about all of them. Efficient market. Rational investor. Even if you write 5, it's good. Rational investor. Unlimited borrowing and lending is allowed at RF. Give me a second, it's not looking great. At RF. So this is one point, this is a second point, this is the third point. Okay, why third point? I'll tell you. Let me come back. Markets are at equilibrium. Okay, the next one is no transaction cost like brokerage, commission, taxes and all that. There is, okay, then they say that people are risk averse, but occasionally they take risk, to increase the returns. I will not write more, don't worry. So first of them, efficient market. What do you mean by that? Efficient market means, what do you mean by efficient market? Efficient market broadly means that the prices of all the securities in the market reflect the risk and return. They are trading at their intrinsic values. Everybody in the market is aware of the risk and return involved. For example, if you are an investor in Sensex, you know which one is a blue chip stock, you know which one is a small cap, you know which one is a mid cap. That means you are aware of the risk and return involved. So you know that the blue chip will have relatively a lower return and a lower risk, and a small cap stock can have a very high return but with a very high risk. So that means markets are efficient, people are informed. That is efficient market. Okay, so this first is done. Then rational investor. What do you mean by rational investor? So if you are a rational investor, that means you will always go for higher return for a lower level of risk. Or suppose if you have two investments, okay, one is having a risk of 10% and one is having a risk of 9%, and both give you a return of 20%. Of course, you are going to choose a return security with a risk of 9%. That is a rational investor. That means you will choose an investment with a lower risk for the same level of return or higher return for the same level of risk. That is a rational. मतलब बुद्धू नहीं है तुम्हारा investor, होशियार है वो. Okay, then unlimited amount of borrowing and lending is possible at RF. In the practical life, there are two rates, one to borrow, one to lend. If you go to the bank, if they quote 10/11, that means you can borrow at 11% and you can invest at 10%. They are saying, please eliminate that assumption. This 10 and 11, there is a spread of 1% of the bank. This is a transaction cost. It is not good for an investor. So they have dropped that thing of they do not want any transaction cost basically, and that is why the assumption says unlimited amount of borrowing and lending is possible at RF. Basically उन्होंने जो derivation करी होगी ना, उसके अंदर में 2 रेट यूज नहीं कर सकते थे वो लोग, एक ही रेट यूज कर सकते थे, इसलिए assumption के तौर पे बोल दिया, क्योंकि तुम सवाल करोगे अरे ऐसे कैसे होता है, तो भाई बोला कि तुम चुप रहो, मेरा ये assumption है इसलिए. Then no transaction cost. I can talk very good Hindi actually. You will enjoy if I talk that Hindi. But the point still remains that you are supposed to write in English. Okay, and if I speak Hindi, you will translate Hindi into English and the words will not come out properly. That is why I'm teaching in English. Number 2, all the people across India can be catered. Okay. Then no transaction cost in the case of brokerage, commission, taxes, nothing. Okay. Then the last point I have written is people are in general risk averse. Means I do not like risk. But if I can take risk at times in order to increase my return. So these are the assumptions, important points. Speak with me. Efficient market, rational investor, no transaction cost, unlimited borrowing and lending. Markets are at equilibrium. That means the investments are neither overvalued nor undervalued. Okay, that is called markets are equilibrium. That means if Reliance is traded at both NSE and BSE, at both places the prices are same. If Reliance is traded at a price of 3,000 at NSE and 2,700 at BSE, I will definitely enter into some kind of arbitrage. I will sell at 3,000 and buy at 2,700 at the same point of time to earn an arbitrage profit. So that part they have said, नहीं ऐसा नहीं है, हमने जो theory बनाई है ना, उसके अंदर में markets are at equilibrium. Like that. Are you good, guys? So I'm not reading this. You can just read on your own. Now, two very important. This I have said in the class also actually. Like instead of 3, we can remember 2. 2 very important points of William Sharpe, which he said is number one. When we talk about risk, he talks only systematic risk. Okay. So market is not like, why should I write? A stock market is not concerned with diversifiable or unsystematic risk. This is one point I always say. And number 2, compensation would be always paid for systematic risk. What is these 2 points if you could remember? That means market is not bothered about the unsystematic risk and an investor will get returns only for assuming systematic risk. Okay, very good. So let's go ahead. You already know all these calculations and everything, not spending time too much. तो तुम मुझ पे भरोसा रखना, जो भी part मुझे लगेगा ना, you can trust me on that part. I am one person who is like diligently I talk about details. Detailing is, the devil is in the detailing. That's what we listen. Okay. So I would not take a shortcut. I don't like shortcuts at all. Now, undervalued and overvalued stocks. I want to show you something. So they say that if actual और expected, actual का मतलब जो हो चुका, expected का मतलब जो सच में होने वाला है. Okay, expected return is greater than should be. What is should be? Should be और CAPM. मतलब CAPM से कैलकुलेट कर, जो भी should be होता है ना, वो फॉर्मूला से लगा के निकालते हैं ना, उसको should be बोलते हैं अपन. Okay, that means the stock is undervalued. I will write only one. Why do we say that? When the means जितना उसको देना चाहिए था उससे ज्यादा वो दे रहा, अच्छा स्टॉक है, अंडरवैल्यूड है. लेकिन दिस क्लैशेस विथ योर नॉर्मल थॉट प्रोसेस. व्हेन द एक्चुअल प्राइस इज ग्रेटर देन द शुड बी प्राइस, द स्टॉक इज एक्चुअली ओवरवैल्यूड. देन why am I writing like this? I'll show you here. So basically 2 situations. So actual return is suppose maybe like 12% and CAPM return is suppose 10%. Possible. So dividend D1 is suppose 10 rupees. Here also D1, you cannot change that. So price will be 10 divided by 0.12. How much do we get? 10 divided by 0.12 is 83.33. And if you divide P0 is equal to 10 divided by 0.10, it is 100. So undervalued ही तो आया ये, because your actual price, careful, I don't know how many of you are able to get. So your actual return is greater than should be return, but here the should be price or the actual price is less than should be. So logic is going the same way actually. It is just the way of interpretation. So please do not get confused. You can remember these calculations as photogenic memory and you will be able to answer your questions. Okay, done. So let's move ahead now again. Advantages of CAPM model. So there are two advantages. Please remember with me. There are two advantages of CAPM model. Risk adjusted return. It helps you. They can ask you that in MCQ maybe. It helps you calculate a risk adjusted return. The risk is beta here. Number two, just remember for the sake of it. Don't get into the logic everywhere. It helps you to calculate returns for a no dividend paying stock. Look at this. No dividend company. And then there are three limitations. Number one, देखो तुम्हारा जो formula है ना, RE equal to RF plus RM minus RF, the whole into beta. What I'm trying to tell you is that, talk about this. So basically they say that it is difficult to calculate beta. Okay, then they talk it is difficult to calculate RF, RM. Okay, then they also talk that only market risk is not the risk involved in a stock. Means if the stock has got risk, the risk is not only about the market, it could be other things also. So these are the certain limitations, and we are done. So talk about beta, talk about RM, RF availability and the information, how to calculate, where to get the data and all that. And the third one, only market risk is not like enough to explain the variation in the stock. There could be other reasons also. Okay, arbitrage pricing theory. Now, your CAPM model gives you RE equal to RF plus RM minus RF into beta. If I summarize this, can I write like this? RF plus RP1 and factor 1. So RP is risk premium part, okay? This is a risk premium part, okay? And this is the beta factor. So RP, and that means this model says that there is only the stock return is dependent on only one factor, and that is market. Even if you want to change that one factor, you are not allowed. It is a stringent model. But APT model is very, very flexible in the sense that they say that we can increase the number of factors which affect the stock. And majorly they say that the factors like inflation rate, interest rate, GDP growth rate, industrial production, monsoon, all these factors affect the return of the stock. So RF, give me 1 minute and you'll be sorted on this model. And that is RP1, F1 plus RP2, F2 and dash 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 RPN and FN. So basically what is this RP here? So RP is basically actual माइनस एक्सपेक्टेड. ओके, एक तुम्हारा सम है, आई डोंट नो रिमेंबर व्हाट इज द नेम ऑफ दैट सम यार. प्रशांत, कौन सा सम है यार? वो बहुत सिंपल सा सम है, एकदम एक लाइन का सम है ना. अरे मैं क्यों भूल गई यार, सामने याद नहीं आ रहा है. बुक में है. ओके, सबसे सिंपल सम है वो, लेकिन जानते अभी याद नहीं आ रहा मेरे को. सो बेसिकली हियर, यहाँ भी है वैसे तो. सो बेसिकली व्हाट आर दे ट्राइंग टू से? दे से दैट suppose I thought that my GDP growth rate will be 10%, okay, but it became 11%. So if the GDP growth rate is extra 1%, don't you think I should get that 1 into sensitivity extra? If all the factors, like if all the RPs go as per plan, that means actual expected becomes 0, then what will happen? By default you will get RF. RF here does not mean T-bill rate. Here it means that if अगर सारे के सारे फैक्टर्स जिनके ऊपर मेरा स्टॉक डिपेंडेंट है वो एक्सपेक्टेशन के हिसाब से ही अगर जाते हैं तो मैं कम से कम आरएफ के जितना तो कमा ही लूंगी. ओके, लेकिन जिन फैक्टर्स पे, कौन से फैक्टर लाइक मॉनसून, जीडीपी, इन्फ्लेशन, इंटरेस्ट रेट, अगर वो एक्सपेक्टेशन के हिसाब से नहीं जाते हैं तो तुमको नहीं लगता कि कहीं पे एक्सपेक्टेशन से ज्यादा जाएगा, कहीं पे एक्सपेक्टेशन से कम जाएगा, तो जिस हिसाब से मेरी उस फैक्टर को सेंसिटिविटी है उससे मल्टीप्लाई करके मेरी रिटर्न को एडजस्ट होना चाहिए. दैट इज द लॉजिक ऑफ एपीटी मॉडल. करेक्ट? यस यस यस. गाइस, डिड यू अंडरस्टैंड दिस एपीटी मॉडल? ऑल ऑफ यू, डिड यू अंडरस्टैंड? So basically CAPM considers only one factor, it considers multiple factors. Okay, so I'm moving ahead since maybe like you will answer. So look at this, I told you. So inflation, level of industrial production, risk premium, term structure of interest rates, portfolio evaluation methods. They have given Sharpe ratio. Okay, Sharpe ratio. Then we have Trainer's ratio. Trainer's ratio. And then we have Jensen's alpha. Okay, Jensen's alpha. So this is RP minus RF divided by sigma P. This is RP minus RF divided by beta P. And this is like RP minus CAPM. Okay, this is called alpha. So here, if you see these three formulas, that means you can use this in order to evaluate how did your portfolio perform in comparison to the index or some other portfolio. How did your portfolio perform, okay, in comparison to the index, okay, or some other portfolio? That is the logic here. So listen to me very carefully. Sharp ratio considers total risk. Trainer's ratio considers only systematic risk. Okay. Now they say that, बहुत important point है, पूरा पैराग्राफ पढ़ना पड़ेगा. अगर तुम मेरी बात नहीं सुनोगे तो यहाँ तक पूरा पढ़ना पड़ेगा. मैं तुमको सबका समराइजेशन दे रही हूँ. Okay. They say that if you are comparing portfolios where there is a into the industry where there is a lot of unsystematic risk, like sectoral funds, okay, maybe like in a particular sector or some particular category of industry where there is a lot of unsystematic risk, then definitely you should use Sharpe ratio to compare the two portfolios, because in Sharpe ratio you take total SD, okay, total risk, systematic and unsystematic. But if you are comparing two portfolios, okay, which are completely diversified. What do you mean by diversified? Diversified means you have eliminated the unsystematic risk, then Trenor ratio would be better than the Sharpe ratio. So they are trying to tell you that if you are trying to compare two investments where there is a lot of unsystematic risk, then use Sharpe ratio. When the portfolios are properly diversified away, then you should go for Trenor ratio. And then they say Jensen's alpha. What is Jensen's alpha? Jensen's alpha means the actual return that your fund manager has generated and the should be return that should have been generated looking at the beta of the stock. मतलब जो तुमने सच में generate किया और जो तुमको करना चाहिए था. If you have generated more, that more is called alpha. Okay, these alphas are calculated to decide the bonuses of the investment manager actually. Okay, but you should always be, they have written there that you should be very, very careful when you are comparing two portfolios. Okay, in terms of Jensen's alpha, you can compare apple to apple. That means you can compare two portfolios which have similar betas. Okay, you cannot compare apple with oranges. मतलब cement industry के portfolio को फार्मा के पोर्टफोलियो से कंपेयर नहीं करके तुम जेंसन अल्फा कैलकुलेट नहीं कर सकते. अगर तुम स्मॉल कैप पोर्टफोलियो कंपेयर कर रहे हो, ओके, तो दोनों स्मॉल कैप ही, दैट मींस कंपेयर एप्पल टू एप्पल, ऑरेंज टू ऑरेंज एंड नॉट एप्पल टू ऑरेंज. 3 बातें बोली है मैंने, ध्यान कर लेना. Guys, are we good? So this whole part talks about that only. I have gone through twice the whole thing. And I remember what they have written. Now, Sharpe's optimal portfolio. यहाँ पे उन्होंने क्या बोला है? That you will calculate RP. Very important. Maybe I have not done this question in the class. Prashant, maybe I will do and put it on the YouTube. RP minus RF divided by beta P. Okay. So basically they are saying that you will calculate this. This is basically Trenor's ratio. So suppose Sharpe's optimal portfolio means what? Okay, Sharpe's optimal portfolio means you will calculate, suppose you are like, क्या बोलते हैं? हाँ, तो basically तुम क्या करोगे? तुम्हारी जो securities हैं, okay, whatever portfolios you have या securities you have, you will first calculate this ratio, okay. Higher the better. Excess return per unit of risk. Excess return per unit of risk. Numerator is excess return divided by per unit of systematic risk. Basically, you will first calculate for all of them and rank them in the descending order, highest. And then what you will do, you will calculate the cutoff point. Okay. So using this formula, of course, this is a very complicated formula, and I am not supposed to explain you the formula, because in the best of the curriculums, they say that you are just supposed to mug up the formula. So you have to mug up the formula. Okay. So first you will calculate this for all like portfolios given, okay, or securities given, and then what will you do? Rank them in the descending order from highest to lowest, and then calculate CI, okay, for all of them. So when you calculate CI, so suppose all the investments which are greater than CI you will include in the portfolio, and all the investments which are lower than the cutoff point you will exclude from the portfolio. Baat khatam. And then you will use this formula maybe, okay, this formula to calculate the weights. For example, the cutoff point is suppose 2.33. Okay, so the cutoff point, the first one's cutoff point is suppose 4. Then this is 3.5. So I'll include this. Then this is 2.2. So I will stop here only. I'll stop here only. Okay, so the cutoff point is suppose 2.33. So I will take only this and this. but how much to invest in the first one, how much to invest in the second one. I will use this formula to calculate the weights. That is the Sharpe's optimal portfolio. Guys, did you understand that part? क्या करना है पता है कि मैंने इंग्लिश में बोल दिया अभी. तुमको क्या करना है कि वो लोग इन्वेस्टमेंट्स देंगे तुमको, तो तुम क्या करोगे, आरपी माइनस आरएफ बाई बीटा. दैट मीन्स एक्सेस जितना ज्यादा होगा उतना अच्छा होगा ना. एक्सेस रिटर्न पर यूनिट ऑफ सिस्टमैटिक रिस्क करके तुम सारी इन्वेस्टमेंट्स का निकालोगे. उसके बाद उन सबको डिसेंडिंग ऑर्डर में तुम रैंक करा दोगे, हाईएस्ट टू लोवेस्ट में. ठीक है, फिर ये सीआई का फॉर्मूला लगा के कट ऑफ पॉइंट निकालोगे. ओके, और वो जो कट ऑफ जहां जब मतलब बेसिकली तुम उन इन्वेस्टमेंट्स को लोगे जिनका वैल्यू मतलब वो जो सीआई है तुम्हारा कैलकुलेटेड, ओके, वो तुम्हारे कट ऑफ पॉइंट से अगर ज्यादा है तो इंक्लूड करोगे, और जहां से वो गिरने लग जाएगा उन सारे इन्वेस्टमेंट्स को तुम इंक्लूड ही नहीं करोगे. तो तुम्हारा वो पोर्टफोलियो ऑप्टिमल बना. और उसके बाद ये जो फॉर्मूला नीचे दे रखा है उसको यूज करके तुम वेट्स भी कैलकुलेट कर सकते हो कि भाई मान लो कि 2 निकले कट ऑफ पॉइंट से, दो ही इन्वेस्टमेंट ऐसे थे जिनका वैल्यू सीआई का कट ऑफ पॉइंट से ज्यादा था, तो कितना डालें, तो तुमको वेट्स भी बता देगा. अंडरस्टूड ना? Okay, great. So let's go ahead. Formulation of portfolio strategy. Guys, we are going very fast. I think we are pending with only 10 pages now. But these 10 pages are the most important ones actually. So active portfolio strategy and passive portfolio strategy. So from here, the proper theory starts. There is no practical part. And if you get a theory, I told you in the last lecture also, I have a high anticipation that you will get theory from this 10-12 pages only in case they give you from portfolio. So what is active portfolio strategy and passive portfolio strategy? First try to understand. So when I am wanting to beat the market by generating superior returns in comparison to the market or some benchmark which I have chosen, that is called active portfolio management. I will try to gather data, do a lot of analysis, identify undervalued stocks and all that. Okay, so I will do all such activities with the help of which I can generate higher returns in comparison to the benchmark, to some index or something in my mind. That is active portfolio management. So what are, look at this, 4 principles. This is important. What are the 4 principles? Market timing, okay, sector rotation, then security selection. मैं इतना अच्छा समझा दूंगी तुमको याद हो जाएगा, पता है. And use of advanced techniques या philosophy, whatever they have written. So 1, 2, 3 and 4. So what is market timing? In market timing, this whole paragraph they are talking about that we would try to time the market using or forecasting. What do you forecast? Business cycles. We would try to forecast business cycles. Okay, then advance decline of the stocks, then econometric models, and we will also use मूविंग एवरेजेस. समझा क्या बोल रही हूं मैं? सो बेसिकली तुम ये सब टेक्निक को यूज करके क्या करोगे पता है? मार्केट को फोरकास्ट करने की कोशिश करोगे. ओ माय गॉड, गिव मी अ सेकेंड प्लीज. रेडी हो गए सब लोग? रेडी है? स्टार्ट करूं? Okay, start. So basically, let me start again because we just lost track of what we were doing. Now, coming back again, relax. Okay, so it's okay. Now, the topic was active portfolio strategy. Okay, active portfolio strategy. So as I told you that there are active portfolio strategy means if you are like doing some extra effort, like you are gathering data, you are analyzing the data, you are trying to do many things in order to generate superior returns than the market or any benchmark that you have in your mind, is called active portfolio strategy. And I've written here 4 principles that are very important. Okay, there are 4 principles. that are very important. And these principles are like market timing, sector rotation, I've written here, okay, market timing. So in market timing, that what do you mean by that? You will try to time the market, okay, with the help of different forecasting models like business cycles, econometric models, moving averages, okay, or advanced decline, calculation of advances and the declines. मतलब तुम क्या करते हो, तुम कोशिश ये करोगे with the help of these tools, तुम ये कोशिश करते हो कि तुम मार्केट कहाँ जाएगा कहाँ नहीं जाएगा ये सब तुम ट्राई करते हो प्रेडिक्ट करने का, ओके, सो दैट कि तुम कैप्चर कर पाओ अर्ली और इन्वेस्ट कर पाओ in order to generate higher returns. Okay, that is market timing. I've written here business cycles. See, I've written here business cycles, then advances or declines, then econometric models and moving averages. If you want, I can, like, a variety of tools are employed, okay, in market timing analysis. Look at this. I'll just underline this. It will be easy for you. Okay, so you will use all this to generate higher returns. Okay. Now, the next one is sector rotation. What do you mean by that? Sector rotation means, guys, suppose you come to know by some calculation or some knowledge or doing some analysis, okay, cement sector will do better or pharma sector will do better. At this point of, suppose you are invested in maybe like a real estate sector and you come to know that, okay, pharma sector will do better. Maybe like the markets were in a boom mode and now the markets are going in a recession mode. So in recessionary market, pharma sector does not like behave as per the market. It does not, it has got a very low beta. So you will try to shift the kind of सेक्टर्स बेसिकली, आई मीन टू से, मतलब अगर तुमको लग रहा है कि तुम अभी तक मान लो रियल एस्टेट में इन्वेस्टेड थे सेक्टर में और तुमको अब लग रहा है नहीं यार मार्केट में रिसेशन आने वाला है तो एक काम करते हैं कि फार्मा में पैसा, तो सेक्टर रोटेशन. So you will try to do all that. Maybe like in case of equities, you will try to change the industry in order to generate higher returns. In terms of bonds also, you can try to shift your like securities into like high coupon rate or like maybe like maturities mein tum shifting kar sakte and all that. So sector rotation both in equity and bond they have written here. Look at this. Okay, sector or group rotation may apply both to stock and the bond component. Okay, here the components of the portfolio are used when it involves shifting. The weighing for various industry sectors is based on their asset outlook. If one thinks that steel and pharma would do well as compared to other sectors in the forthcoming period, he may overweigh the sector relative to their position in the market portfolio. I'm sure whatever I explained was a bit layman in language. That is what they have trying to say. With respect to the bond portfolio, you will try to change the composition of the portfolio. Maybe like, kind of you want to change the maturities from short term to long term, or maybe you want to invest in securities or bonds which are giving higher YTMs or maybe higher coupon rates or something like that. That is called sector rotation. That means by using all these techniques, you will try to beat the market or generate superior returns. I mean, passive में क्या होता है, तुम बैठे रहते हो, कुछ नहीं करते हो, no change, status quo is maintained basically. Okay, now security selection. So third one is security selection. You will use like fundamental, technical and methods to choose the securities. मैं बहुत डिटेल में नहीं जा रही, देखो यहाँ पे लिखा हुआ है market timing, sector rotation and security selection. Then use of a specialized investment concept. So they are saying that you will use some specialized investment philosophy or some approach where you have some extra ability in order to like forecast something and invest in those kind of investment so that you are able to generate super normal returns in comparison to the other peer group, peer portfolios or other fund managers or market for that matter. Okay, so going ahead, passive portfolio strategy. Here you do nothing. Means once you develop the portfolio, you understand the risk return profile of the investor, you develop a portfolio and then you do not change. You just try to, you think that markets are efficient, okay, markets are efficient and you do not need to do something extra in order to generate superior returns because any which ways you will not be. So that is the idea behind passive. So basically buy and hold. Okay, so these are the two things written here. What the extra thing that you should know here is that they are saying that passive means investing in the index funds. Passive means investing in index funds. Okay, So what is an index fund? Index funds means, suppose I identify Nifty 50. Okay, so I will buy the same stocks which are there in the Nifty 50, okay, in the same weight. So basically you develop a portfolio which tracks your kind of, तुम एक ऐसा पोर्टफोलियो बना लोगे, ओके, जो तुम्हारे एक जिस बेंचमार्क को तुमने आइडेंटिफाई किया, इंडेक्स को आइडेंटिफाई किया, उसको ट्रैक करेगा वो. So Nifty 50 में suppose there are 50 stocks, you'll buy the same stocks, okay, and in the same weights also. So basically you don't have to do anything. If the markets perform good, your portfolio is going to perform the same. If you see guys properly, if you have seen properly, haven't you seen that Nifty is a subset of Sensex, but the percentage change, Nifty does not have the same number of the stocks the way Sensex has, okay, but the percentage change in both of them is almost same. Because Nifty has got all the heavyweight stocks which are there in the Sensex. I mean to say 20% of the stocks, सुनना ध्यान से, 20% of the stocks of the Sensex are 80% of the weights of the Sensex. So buy those 20%, leave that 80%. I mean to say that. So that is passive method. Okay, then selection of the securities they are saying. So if you are selecting bonds, on what basis will you select? Number one, yield to maturity. That means higher yield, low default risk, high liquidity, and all that they have given. You know, the risk of default is high, low, and all that. So yield to maturity, risk of default, tax, it gives you tax advantage, and fourth, liquidity. I don't think that I should explain you more than this. Okay, again, you can count on the fingers. Number one, high yield to maturity, then tax advantage, then high liquidity, and low default risk. When you're talking about equity share, you'll use technical analysis, fundamental analysis, and random walk theory and efficient market hypothesis. So technical analysis, fundamental, matlab, what would you consider while selecting a security? That is what they are trying to say. Okay, and random selection. So guys, now we are coming to portfolio revision and rebalancing. Okay, so three methods are there: buy and hold. Okay, buy and hold. Then constant ratio, and CPPI, constant proportion portfolio investment. Okay, so what is buy and hold? In a buy and hold strategy, मुझे लगता है कि मैंने जो प्रैक्टिकल में पढ़ाया है ना क्लास के अंदर में, उससे थोड़ा डिफरेंट थ्योरी लिख रखी है. सुन लो, अच्छा रहेगा. तुमको टाइम नहीं मिलने वाला है वापस से कि तुम खुद से कर पाओगे, इसलिए थोड़ा आधा घंटा ज़्यादा जाता है, इन्वेस्ट कर लो. मैं तो रादर ये सोच रही हूँ कि मैं जो तुमको 15 चैप्टर पढ़ा रही हूँ ना पूरा यूट्यूब पे, मतलब इतने घंटे होंगे, मुझे भी नहीं पता कितने, कम से कम मेरा मानना है 40 घंटे तो होंगे ही होंगे, 35-40 घंटे तो होंगे ही सब मिला करके, राइट. मेरा ये मानना है, मैं ऐसे मन में अपने ये सोचती हूँ कि इन 40 घंटों की मेहनत में इफ़ यू आर एबल टू सॉल्व वन क्वेश्चन ऑफ 10 मार्क्स ऑल्सो ना, माई ऑल हार्ड वर्क विल बी पेड ऑफ. I am not looking for that whatever I have taught you will be able to solve all the questions. I am not looking for that. I am just thinking that if because of these lectures, if you're able to solve one question also of 10 marks, I think we are paid off. And 10 marks matter a lot, guys. And believe me, you are not going to get the kind of time you are under strain because you have exams samne mein. So you will not be able to come to this again. It is not possible for any one of you. So don't think that I will do later. You will not get time to do later. So you should do along with me and finish it off. That's the best way. I'm telling out of my experience only. And that doesn't mean कि मैं ये चाहती हूँ तुम लाइव में बैठो and all that. मेरा इस बात से कोई लेना देना नहीं है. बट मैं जानती हूँ ना कि आगे कंस्ट्रेंट ऑफ टाइम कैसा आने वाला है. मेरे साथ अगर हो गया तो हो जाएगा, वरना होने नहीं वाला है. तुमको क्यों लगता है इतना बड़ा थियोरी तुम पढ़ना चाहते नहीं हो? ऐसा नहीं है. टाइम का है तुम्हारे पास में, है ना? तो साथ में करके ख़त्म करो. इसे थोड़ा पेशेंस रखो. मैं पैनिक होती हूँ अगर तुमको, मुझे ऐसा लगने लगता है कि मैं ज़्यादा टाइम ले रही हूँ, मैं खुद ही पैनिक होने लग जाती हूँ. मतलब मैं आराम से फिर नहीं पढ़ा पाती. तो थोड़ा ठंड रखते हैं. 10-15 मिनट में ज़्यादा ज़िंदगी में कुछ, लेकिन उस समय रोना नहीं आएगा ना. पेपर में जब तुमको लगेगा कि यार ये वाला अगर काश मैंने कर लिया होता, मैम ने तो पढ़ाया था, मैंने ध्यान क्यों नहीं दिया, मेरे हाथ से 10 नंबर निकल गए. पूरी 6 महीने की बात आएगी. और 6 महीना छोड़ो, इतनी तकलीफ वापस उस चीज़ को पढ़ने की, वो तो इमेजिन भी नहीं कर सकते. ओके, इसलिए कोई अगर तुम्हें हेल्प कर रहा है, ऐसा नहीं मैं तुम्हें एहसान नहीं कर रही, ओके, लेकिन अगर हेल्प हो रही है तो ले लो हेल्प. मेरा ये कहने का मतलब है ना. चलो स्टार्ट. सो बाय एंड होल्ड स्ट्रैटेजी, कांस्टेंट रेशियो प्लान, एंड कांस्टेंट प्रोपोर्शन पोर्टफोलियो इंश्योरेंस, मैं इसका फुल फॉर्म हमेशा ही भूल जाती हूँ, सीपीपीआई याद रहता है. ओके, नाउ व्हाट इज बाय एंड होल्ड? सो इन अ बाय, व्हाट आई एम टॉकिंग ओनली व्हाट दे हैव रिटन. इन बाय एंड होल्ड दे आर सेइंग दैट you invest certain amount of money in bonds, okay, because your money will not get a damage for that matter, and certain amount of money in the equity, okay. And basically you want to have, like, there's a word they have used, floor, okay. So there is a floor that you want. For example, you suppose you have 5 lakh rupees to be invested, and you want that my portfolio should not go below 3.5 lakhs. So 3.5 lakhs would be invested in the bond, because if you invest in the bonds, your money will not go below, even if the equity value becomes a zero, your portfolio will remain intact at 3.5 lakhs, okay. So they are saying that that is a floor value. So basically, depending on the floor, and always believe me, people who are more risk averse, जिनको डर ज़्यादा लगता है, वो बॉन्ड में ज़्यादा पैसा डालेंगे, इक्विटी में कम डालेंगे, कॉमन सेंस की बात है. ओके, नाउ सो बेसिकली देयर इज अ फ्लोर, सो यू डिवाइड योर मनी बिटवीन फ्लोर एंड equity, but the value of the portfolio would be directly proportional to the price of the stock, because that bond part is not changing any which ways. So the value of the portfolio is directly proportional to the prices of the stock for that matter, and that is the diagram they are drawing. They are saying that there is a linear relationship. The value of the portfolio is dependent on the price of the stock. There is a linear relationship. That means to say, if you have 1 lakh rupees, 50,000 you divide between bonds and stocks, and if the value of the equity part becomes 1 lakh, the total portfolio becomes 1,50,000, okay, that way. So there is a linear relationship, okay. So they have written something here, look at that, the value of the portfolio, look at this here, the value of the portfolio is positively and linearly dependent on the value of the stock. The value of the portfolio cannot fall below the floor value, okay. And this method would perform good if initially, okay, if the weights of equity is higher. ये पोर्टफोलियो तब अच्छा करेगा जब शुरुआत में अगर इक्विटी का पोर्शन बॉन्ड से ज्यादा है और इक्विटी बॉन्ड को आउट परफॉर्म कर जाए. ये पॉइंट तुमको एग्जाम में याद नहीं रहने वाला, ये 2 याद रहेगा तो काम हो जाएगा तुम्हारा, बट थोड़ा थोड़ा लिख देना वहां पे, अपने मन से बना बना के थोड़ा चलेगा, okay. So this is basically buy and hold strategy. There is a floor, okay, and the value of the portfolio is dependent on the value of the stock, and this portfolio will perform good if initially the percentage of the equity is higher and equity performs better than the bond. If it doesn't, then it will be other way around. Then constant mix policy, what does it say? Constant mix policy says that if you suppose have 1 lakh rupees and you decide to have 50-50%, that decision you have to take, 50% bond, 50% equity. So you invest 50% in equity, 50% in bonds or cash and cash equivalents, okay. And because of the change in the equity prices, the value of the portfolio changes. For example, the value of the equity becomes 30,000 because of the fall in the stock market. So the total value of the portfolio is how much? 50,000 plus 30,000. How much is that? That's 80,000. So if there is a change, suppose you will decide, okay, when the market changes by 10%, I will rebalance the portfolio. Rebalancing means bringing the original proportion back. What was our original proportion? 50-50%. So what will you do? 40,000 you will keep. So in order to keep equity में 40,000, you will have to take money from the bonds worth 10,000. So what you have to remember here is that in constant proportion portfolio, you buy stocks when the market goes down. You buy stocks when the market goes down. You sell stocks when the market goes up. इससे ज़्यादा याद मत करो, याद रहने नहीं वाला है तुमको. Okay? So it will give you, there can be an MCQ. It gives you concave type of diagram. Your buy and hold gives you a linear. Your constant proportion, constant ratio plan gives you a concave, and CPPI method gives you a convex. What is CPPI method, guys? In CPPI method, you basically, it is exactly ulta of, opposite of constant ratio plan. So basically what is happening here? In constant ratio plan, you buy stocks when the market goes down, okay, and you sell stocks when the market goes up. In CPPI method, you do opposite. You sell stocks when market goes down and you buy stocks when market goes up. इससे ज़्यादा कुछ नहीं बोल रही मैं तुमको, because there's a practical part, you can manage that. Now coming to this asset allocation strategies, 3 strategies: integrated, strategic and tactical allocation. Okay, इंटी पढ़ लेना ये वाला, मैं बोलूँगी तुमको याद नहीं रहेगा, but ये important है. पढ़ लेना, you have to remember those exact words only. So integrated asset allocation, strategic बोलोगे तो बोल देती हूँ. Integrated asset allocation is like combining the capital market overview with the objectives. मतलब बेसिकली कस्टमर की जो, इन्वेस्टर की जो ऑब्जेक्टिव है और मार्केट का जो ओवरव्यू है, उन दोनों को कंबाइन करके तुम एक पोर्टफोलियो बनाते हो. दैट इज इंटीग्रेटेड एसेट एलोकेशन. स्ट्रेटेजिक एसेट एलोकेशन में क्या होता है, दैट यू स्टडी रिस्क रिटर्न कोवेरिएंसेस एंड ट्राई टू अंडरस्टैंड ऑन द basis of historical data. I told you that is why that you will not be able to recall what I am saying now. So it is better that you study on your own. I do understand what you will be able to recall, what I speak, and what you will not be. You will not be able to. So remember three. Integrated मेरे साथ वो बोल लो. Integrated, strategic, and tactical. And we are done, guys, here. Now, fixed income portfolio. You know how did I remember this? S, मैं देख नहीं रही हूँ. SDSSE. What is that? Setting up objective, defining investment policy, selection of the strategy, passive or active. मैं देख नहीं रही हूँ. Then selection of security selection, and then evaluation. Look at this. Setting up SDSSE. You cannot recall all this. Setting up objective, drafting guidelines, selection of the portfolio, strategy, active, passive, selection of securities, and evaluation of performance and the benchmark. Okay. So SDSSE. Bolo, SDSSE. Okay, S is setting up objective, D is defining investment policy, then S is selection of the strategy, active, passive, selection of the securities, that, okay, and then E is evaluation. Then the kind of returns, arithmetic return, money weighted return, time weighted return, annualized return, rupee weighted return. So this is given to you. Okay, again, fixed income point of view, so they've given passive and active. This is again very important topic, active and passive. This I'll explain you. This is a proper topic actually. So in fixed income, in bonds, how do you decide on active and passive portfolios basically? Okay, so passive methods, I'll write here. Passive methods, it is important topic. In passive method, one is indexation. मैं explain कर दूंगी, तुम्हें याद हो जाएगा. Indexation, one word you already know, immunization. Immunization. Okay, then you have like matching of cash flows. Matching of cash flows. एक और है, buy and hold. Buy and hold. Okay, so these are four. So buy and hold, indexation, immunization, and cash flow matching. I'll tell you. Passive means you do not do much churning. Okay, what do you mean by passive? You do not do churning, means shifting, buying, selling, changing, you do not do all this. Okay, so in indexation, what you do, you choose a benchmark, okay, and try, and your portfolio will track that benchmark. मतलब जो अभी मैंने तुमको निफ्टी 50 का एग्जांपल दिया, सेम. That is indexation. Okay, then what is buy and hold? You will buy and try to hold. Okay, but पैसिव का मतलब ये नहीं होता कि बस ऐसे लेके बैठे रहते हैं, ऐसा नहीं होता है. थोड़े थोड़े चेंजेस हम करते रहते हैं, ऐसा नहीं. एग्रेसिव नहीं होते हम, वो मेन पॉइंट है. वी डू नॉट बिकम एग्रेसिव देयर. ओके, नाउ then immunization means basically you have studied that part, matching of DA and DL. You try to immunize your portfolio, bond portfolio, with the help of duration. So when you immunize, even if the market goes, interest rates go up and down, your YTM, the YTM or the realized yield does not change. That is immunization. And then you try to match the cash flows by using the zero coupon bonds. ये पढ़ना चाहिए हम लोग को यहाँ से, ये बहुत अच्छा दिया हुआ है उन्होंने. So I think we should definitely, I'll change the color. I'm bored of blue now. So buy and hold strategy. Okay. Indexation, immunization, matching of the cash. Look at this. So this technique is nothing, do nothing technique. Investor continues with the initial selection. Do not attempt to churn the portfolio to increase the return. Okay, they are not aggressive. Okay, however, sometimes to control the interest rate risk, the investor may set the duration. छोड़ देना ये line नहीं माने तो. The strategy involves replication of a predetermined benchmark, the way we discussed. Immunization. This strategy cannot be called as purely passive. It is a mixture actually. Okay, so basically what have they written? Since this strategy cannot exactly be termed as purely passive strategy, but a hybrid strategy. The strategy more popular among pension funds. ये important point था actually. Since pension funds promise to pay, immunization में यही तो मैंने सिखाया था class के अंदर में. So basically suppose you develop a liability. that I have to pay 12% every year. So if you buy a portfolio of bonds, okay, there is no guarantee it will generate 20%, 12% for you. There is no guarantee. So how will you be able to meet your liability? Okay. So when you do immunization, what happens? You set the duration of the portfolio in such a manner, of the bond portfolio. Why there is no guarantee? Because of the price risk and the reinvestment risk. That means to say, when I built the portfolio, the YTM of the portfolio was 12%. Okay. And I developed the liability, means 12% I will generate and 12% I will pay. That is how I wanted to. But with the passage of the time, because of the change in the interest rate in the market, this portfolio will give sometimes more than 12, sometimes less than 12. I don't want more, but I don't want less also, because there is a liability standing. Okay. So that is what they have given the example of a pension fund. So the pension fund means in US and all, a lot of money in the form of pension. There's a huge millions and billions of dollars are there in the pension funds. These are very hard-earned money of all the people who are already at old age. You cannot spoil their money. You cannot generate less amount of money. So that is why we do not get into active strategy, because you might lose money in that. So that generating cash flows for that particular pension fund is a liability. So I will do immunization, so that those people do not want more. They say, whatever you promised, 5%, 6%, just keep generating that. That means I have to generate 5, 6% every year to meet that liability. That's what they have written, guys. Then matching of the cash flows. So basically you buy zero coupon bonds to meet the promised payment. So again, buy and hold, indexation, immunization, and cash flow matching. Active strategy. This is also very, very nicely written actually. So first one is forecasting interest rates. देखो यहाँ पे forecasting returns and interest rates. Okay. So in the active strategy, what will you do? Do you remember interest rate anticipation and portfolio churning? There is a question in your book or in your material, basically GOI, Government of India bonds. There are multiple bonds in the question, and then they say that interest rates are going up. So what you do? You sell the highest maturity bond and shift to the lowest maturity, and so on and so forth. That is active management. That means you're churning the portfolio with the help of, the name of the topic is interest rate anticipation and portfolio churning. Are you aware of the fact that if you have a bond portfolio and you have bonds with different maturities, long term, short term, okay, and maybe like one bond is 2-year maturity, then 5-year, then 10-year, then 30-year, okay. So if the interest rates go up, all the bonds will go down. There is an inverse relationship, but the longest maturity bond will lose the highest amount of value in comparison to the lowest maturity bond. So what should you do? When you are trying to forecast and you come to know that, okay, interest rates are going up and I will lose more on the 30-year bond, you will sell the 30-year bond and shift the proceeds into low maturity. Okay, that is what they are saying. Forecasting returns and interest rates. ये सब लिखा हुआ है यहाँ पे. अब उसमें कुछ strategies लिखी हुई है. Bullet strategy, barbell strategy, and ladder strategy. So bullet strategy means basically you invest all your money in one particular maturity only. You do not shift maturities. In barbell strategy, you invest in 2 maturities, one very short term, one very long term. In ladder strategy, you invest in various maturities like 2-year, 5-year, 15-year, 20-year, 25, 30. That's ladder strategy. 5-year, 20-year, barbell strategy. Only 5-year, only 20-year, bullet strategy. Okay, then they are saying, kind of I'm not getting into too much. ये important point of वापस forecast active में forecasting returns and interest rates, and in this you have bullet, barbell, and ladder. Then you have second, bond swaps. That means you'll be changing the bonds from here and there. The first one they are saying is pure yield pickup swap. This is all are very important. Substitution swap, this you can get in MCQ. Remember please. International spread swap and tax swap. अब थोड़ा सा रिलैक्स हो जाओ, बिकॉज टॉपिक खत्म होने वाला. मुझे नहीं पता कितने पेजेस बचे हुए, 2 पेज और बचे हुए, लेकिन ये पार्ट से एमसीक्यू जरूर आ सकता है तुमको, इसलिए बिल्कुल रिलैक्स हो जाओ तुम. अब सुनना ही पड़ेगा, तुम्हारे पास चॉइस नहीं है बिना सुने बिना. अब सुनना ध्यान से. तो पहला था फोरकास्टिंग में वी हैड बुलेट, बारबेल एंड लैडर. प्लीज रिमेंबर व्हाट वाज दैट. बुलेट में 1 मैच्योरिटी, बारबेल में 2 एक्सट्रीम मैच्योरिटीज, एंड ladder में multiple maturities. Okay, then bond swaps. The first one is pure yield pickup swap. So what do you do here? You will sell low yielding bonds and shift the money to high yielding bonds. Are you good? In the same quantity. Look at this. They say that this strategy involves switch from a lower yield bond to a higher yield bonds, almost identical in quantity and quality. Okay, this strategy is suitable for a portfolio manager who is ready to take interest rate risk, because the change can lead to some amount of loss of money also. Okay, but you do not need to know this. You need to know that what is a pure yield pickup swap. A pure yield pickup swap means selling the bonds with low yield, okay, and shifting that money to high yields which are similar in quality. Okay, then what is substitution swap? In substitution swap, they say that in markets, similar bonds, okay, similar bonds means with similar coupon rate, similar yield, similar maturities, but there are some mispricing out there. Some are undervalued, some are overvalued. So what you do, you try to exploit that mispricing by buying and selling bonds. That is called substitution swap. Look at this. This swapping involves swapping with similar type of bonds in terms of coupon, rate, maturity, but with different prices. This type of difference exists due to temporary imbalance in the market. The risk of the portfolio manager carries swapped bonds may not. Basically, what are they trying to say? That you might try to exploit the mispricing. So the risk is that when you sell, okay, when you sell a particular variety of the bond to buy a similar variety, you might not be able to get exactly the same variety. That means it is quite possible the agenda of your portfolio might get disturbed a bit. So what is your pure yield? Low yield to high yield. Substitution swap is basically exploit the mispricing, means you're trying to block that price. Okay, so similar bonds, you sell a overpriced and buy the underpriced. That is what I mean. That's what I can. International spread swap. I do not agree that the name should be international actually. So basically, they are saying that even if we have invested in the same sectors, okay, it is quite possible that there is a gap in the spread. Look at that, what they have written here. In the swap, portfolio manager is of the belief that yield spreads between two sectors is temporarily out of line and tries to take benefit from this mismatch. So यहाँ पे क्या बोल रहे हैं? यील्ड स्प्रेड्स दो सेक्टर में गैप होता है, उसका बेनिफिट को बोलते हैं इंटरनेशनल स्प्रेड स्वैप. देन टैक्स स्वैप. सो दिस आई डू अ लॉट. दिस मैं बहुत ज्यादा ये करती. ओके, आई एम रेडी. आई वाज सेइंग कि मैं ये बहुत ज़्यादा करती हूँ, ये वाला. दिस इज बेस्ड ऑन व्हाट आई डू. आई टेल यू व्हाट आई डू. So suppose I have a portfolio of maybe like, kind of any amount you can take, 1 CR maybe, example. And I earned like, okay, 1 CR, okay, my portfolio value, okay. And I earned around like 30 lakhs this year, example, okay. And I am making losses on some stocks, like maybe one stock is giving me a loss of 10 lakhs notional, okay. I know that I have to pay tax on this 30. This is realized again. This is मैं तो आज ये पढ़ी. I today only when I read this I thought shit, मैं तो ये कब से करते आ रही हूँ. So basically what I do, suppose I have to pay a tax on this amount, right? And this is the loss in my portfolio notional. I will sell this stocks at a loss of 10 lakhs. That reduces my tax bill. Okay, that reduces my tax bill. And what I will do, the moment I book the loss, my tax bill goes down. Okay. And then what I do, I immediately buy the stock again, maybe like a similar stock or some other stock. So basically, for example, this time I'm making a lot of loss in the options, maybe because it did not go, though I still have a lot of chances to win. But then if I am not able to get my price till the end of March, on the day of the expiry of the options, okay, so I will book the loss in the options. Why should I book the loss? Anyway, I'll have to book the loss, but I will book the loss because the income in the options, okay, whatever you earn in the options can be taken as a sort of set off in the business gains. Actually, are you aware of that? I'm sure you are aware of that. ओके तो बेसिकली क्या होगा कि मेरा जो बिजनेस गेन्स है, ओके, मेरी जो बिजनेस इनकम है उसमें मुझे सेट ऑफ मिल जाएगा टैक्स का. तो ये मैं बहुत ज़्यादा करती हूँ. मतलब मैं 10-15 लाख रुपए का अगर लॉस रहता है और मेरा कैपिटल, मेरा गेन अगर बहुत ज़्यादा है जिसमें मुझे बहुत टैक्स पे करना पड़ेगा, तो मैं लॉस काट देती हूँ, मैं लॉस को बुक कर लेती हूँ. लॉस बुक करने से क्या होता है कि तुम्हारा जो टैक्स का बिल है वो कम हो जाता है. और जितने पैसे का मैंने जिस इन्वेस्टमेंट को मैंने बेचा, उस इन्वेस्टमेंट से तुरंत मैं कोई बेटर इन्वेस्टमेंट खरीद लेती हूँ, या फिर अगर उसमें ही मुझे कॉन्फिडेंस है तो वापस उसको खरीद लेती हूँ. लेकिन इमीडिएट बेसिस से मेरा जो टैक्स का बिल है वो काफ़ी कम हो जाएगा. तो अगर 30% का टैक्स है गाइस, तो 9 लाख का मेरे को गेन आता है इसके ऊपर में. Okay, so we are done with this. Now, alternative investment avenues. We are on the last topic. So what are alternative investments? There are a lot of investments which are like not like bonds and equity. Okay, they are like real estate, then ETFs, then you have hedge funds, then you have like so many things that they have given here, guys. So first of all, the features of this is important part. This is very important. Please do not miss out on this. Okay. Now here, so the main features are the fees is the transaction cost of alternative investments are high. Then there is a lack of transparency, lack of historical record. Okay, look at this. So high transaction cost, limited historical data, then it is illiquid and less transparency. Extensive research is required because, like for example, if we talk about equity, we know equity since last 100-200 years now. Okay, but we do not know much about these. So please remember 4 or 5 and you would be sorted. Again, talk with me or speak with me. Less transparency, no historical data is available, extensive research is required, liquidity is not available, and there are high transaction cost for that. Okay, and leveraged buying. So futures options or something like that, there is hedge funds, there is a lot of leverage buying. So if you can remember 5, we are sorted there. So given such a long list, real estate, gold, ETFs, then hedge funds, mutual funds, commodity, distressed securities and all that. So this is the list, private equity. This is a list of your alternative investments. Alternative means other than bond and equity. So they are talking about real estate, guys. I'll talk whatever they have written. So they are saying that real estate is like the way you have financial claims. If equity and bond are in the form of the financial claims, but this is physical in nature, like land, then building, then warehouses, then offices and all that. So this is the investment in the real estate. Okay, number 1 definition. Number 2, they say that the markets for the real estate has not developed too much on an international basis because the laws which are applicable to the real estate in different countries are very, very different. But with the kind of globalization and so many things, you know, the things are becoming more and more transparent, and even the international investors are wanting to invest in the real estate. But there are some features. The transaction cost of a real estate is very, very high. The liquidity is relatively on a lower side. Okay, then they have given 2-3 things, guys, like there is no organized market for real estate. Okay, so inefficient market, then illiquidity, then exact comparison is not possible, high transaction cost, and no organized market. If you can remember 4, number 1, high transaction cost, less amount of liquidity, less comparison, and no organized market. So we are done with this also. So please, valuation of ये भी important है. देखो फिर से बोलती हूँ तुमको, real estate में first thing I told was that real estate are real claims, physical claims on buildings, warehouses, offices and all that, unlike financial claims of bonds and equities, right? So the laws applicable to the real estate in each country is very, very different. Okay, that's the definition part. Okay, and hence the market for real estate has not grown the way it has grown for bond and equity. Point number 1. Point number 2, some specific features because real estate investment is complex. I told you this, if you can remember four, it will be very good. Number one, high transaction cost, illiquidity, no comparison, and no organized market. Done. Then in order to do a valuation of the real estate, they've given four methods. Number one, sales comparison method, means PE multiple approach. Number two, cost approach, means if suppose this building is replaced, okay, then what will be the cost to replace plus the value of the land. Then third one, they have given income approach. In income approach, you will value a land same like irredeemable debenture or irredeemable preferential, that means A by R, the perpetuity formula, and discounted after cash flows. So sales comparison approach, it is like price earning multiplier. Okay, that means अगर तुम्हारा समझो, अगर suppose we stay in India, Bombay, okay, in Bombay suppose I stay in like Andheri, okay, so in Andheri, if there are two properties side by side, if I know the value of this property, with the help of that I can try to take out the value of the second property also. That's sales comparison approach. Number two, then cost replacement approach, means what will it take to replace the whole thing plus the value of the land. Number three, the income approach, that means normal perpetuity formula, A by R you will do. So rental income divided by the discounting factor of the real estate will be your formula, and then your cash flow. You will discount the cash flows of a real estate. Cash flows of a real estate will be the rental income. Okay, so we are done on that. Now this is what they have added, guys, gold. So gold has been always a very, very important part of the investment, especially in India, in the form of jewelry. But then jewelry is not considered as a very good mode of investment, because the vendors from whom, the business houses or the shops from where you buy, like for example, if I buy from Tanishq or I buy from TBZ or something like that, there is something called making charges. They charge you making charge while buying and while selling also. So there is a lot of loss of money if you do that. So investment in the form of jewelry, but in India it is very, very popular. Okay, so they have given some other modes of investment in gold. Number one, gold bars. Okay, so you can invest in gold bars like coins and bars of different denominations, but there would be a problem of physical storage in that case. Number one. Number two, sovereign gold bonds. Okay, so what are sovereign gold? So they have given 4 or 5 guys: gold bars, sovereign gold bonds, then gold ETFs, and then e-gold. Okay, 4 or 5 modes that they have given. This is an important question from the examination perspective, definitely, because this has been new added actually. So what are sovereign gold bonds? The government of India has issued sovereign gold bonds. RBI does on behalf of the government actually. So the way you have different denominations in terms of gold, so gold bonds are also for different denominations of the gold. The best part is that there is no physical storage involved, and there is no like you don't lose money basically. Okay, that means you have to pay cash on the basis of the price of the gold on that day, and when you sell the bond, you get the price of the gold prevailing on that day plus the interest also. So there is a lot of security factor which is not there in terms of the jewelry actually. That is called gold bars, sovereign gold bonds. Then you have gold ETFs. I don't know whether you know this or not. If you go to Zerodha, you will search gold ETF, you will see Kotak gold ETFs, HDFC gold ETFs. So basically it is nothing but the value of the gold. That means instead of buying a physical gold, you are buying like a mutual fund of the gold. The value of the gold ETF changes as per the change in the value of the gold on a daily basis. So it is very, very easy. Why? You can invest small amounts like 1,000 also. If you want to go and buy some coin, even if you want to buy like 1 gram or something as of today, you will have to invest like 7,000, 6,000 in order to buy that 1 gram. Okay. But here in ETFs, and then you will have to store and then go and resell. I have not told you something, and let me tell you something, that even if you go and sell that gold coin to Tanishq, they cut the making charges. So maybe even if you fight that what was the making charge in a gold coin, it's not a jewelry, yet they do not agree to that. They cut 7% making charges on a gold coin. So what is the point? 7% is a good return actually. So it is better to buy gold ETFs because you can invest 1,000 rupees also. Okay. Then you have e-gold. It is same as gold ETFs. That means it is in the form of demat account actually. Same as gold ETF. The benefits are same. Okay. So here it is given sovereign. Then they have given gold ETFs. Then they have given e-gold. Then distressed securities, the last topic. GST also, of course. So what are distressed securities, guys? So there are companies which are almost like in the like on the verge of dying actually. So you try to invest in those type of companies. You might ask me a question that, ma'am, why should I invest? So you invest you invest. What do? In such kind of securities, you buy the debt. That means you invest in the debt and you short sell the equity. That's what they have written. You invest in the debt, okay, and you short the equity of that particular company. Why? If the company starts doing well, that means if it recovers, what will happen? The interest that you get, because interest has to be very, very high because you are investing in a distressed company, okay, the interest amount will be very, very high, okay. And if the company does not do great, then the value that you will get because of the short sell will be very, very high. So in any which ways you are going to earn some good amount of money. I'll read this paragraph because I have discussed in very short actually. In purchasing the securities of the company that are near bankruptcy, since these securities are available at a very low price, the main purpose of buying such securities is to make efforts to revive the sick company. Okay. Further, these securities are suitable to those investors who cannot participate in the market because it involves a lot of due diligence. Guys, पढ़ लेना ना, अभी खत्म करते हैं, ठीक है? So we are done this, guys. Just read this because this is an important topic. I'm going on to the questions. Now, start. Oh. Ready, all of you? So you'll answer the questions now. I think everybody waits for this moment to happen. Okay. Mr. A and Mr. B were arguing over risk diversification of a portfolio. As per Mr. A, we need to select two stocks with coefficient of correlation +1 for perfect diversification, whereas Mr. B said it should be -1. Whose argument do you agree with? ये मैंने बनाए हैं ये सब. This I try to create. I can create very good questions actually, I don't get too much of time, but yeah, I can create very good questions. I feel this time I realize that I can create. Uske pehle I didn't need to, because we did not. I mean, there were already a lot of questions which was given from the institute side, so I did not need to. This time I need to. Mr. B, yes. Mr. B. Yes. Mr. Zindabad identified a T-bill and a stock. Careful. Mr. Zindabad identified a T-bill and a stock and combined them into 5,000 combinations. Okay. Not only that, he also plotted them on an XY axis. The shape of the plot, yes, very correct, very much correct, yes, for himself, and chose one portfolio which exactly intersected with one of the portfolios on the curve, which looked like a hockey stick. Please answer the following questions. All the combinations are called optimal portfolio, efficient curve, or feasible portfolios. Yes, please read the question and give me an answer. What will be the answer for all the combinations? Give an answer for this one. So basically what did he do? He took two securities, combined them into 5,000 combinations, computed RP bar and sigma p for all of them, okay, and plotted them on a XY axis, okay. So what all those combinations which are plotted on an XY axis, we did in the last lecture actually. What are they called? What are all those combinations? What are all those 5,000 combinations are called? Bolo, answer bolo. No. Prashant. No. No. Wrong. Yashvi says 2 ka D. Only Yashvi is correct. Yes. Only Yashvi is correct. So look at this. These combinations are called feasible combinations. 2 ka D. Yes, answer will be 2 ka D. Feasible combinations. Okay. So, yes, it should be D. So these are like all these portfolios, all those 5,000 combinations have been plotted. This is sigma p and this is rp bar. Okay. The curve which looks like a hockey stick is called. Can you answer me this? Yes, it has to be D. Yes, the curve which looks like a hockey stick is called. What do you call that? Optimal portfolio, efficient curve, or feasible portfolios? Okay, misunderstood the question. That's okay. All the combinations are called feasible portfolios, right? Now the curve which looks like a hockey stick is called. That is okay completely. अच्छा तो है, गलत तो होना ही चाहिए. सब सही क्यों होना है? गलत होना ही चाहिए. यहाँ गलत होगा तब तो वहां गलत नहीं होगा, राइट? अभी डिस्कशन में आता ही नहीं ना ये. चलो कोई नहीं. बताओ कि इस कर्व को क्या बोलते हैं? The curve which looks like a hockey stick is called Tuka C, efficient curve. This curve is called efficient curve. Correct. Efficient curve we say. And all the combinations which are lying on the curve are called what? All the combinations which lie on the curve are called what? Third का आंसर बोलो. So all the combinations, सारे combinations को plot कर दिया, वो feasible combination का पहले सारा डाल दो. फिर उसके बाद जो exterior left वाले ना उसको सारों को एक curve से connect कर दो, उसको efficient curve बोलेंगे. 3 का B. Yes, 3 का B is answer. Efficient portfolios. Yes, very good. Very good. Very good. Very good. Yes. And the one chosen by Mr. Zindabad is called what? अब तो आंसर निकल ही जाएगा. That one chosen by Mr. Zindabad is called what? Optimal portfolio. That is the optimal portfolio for that guy. So maybe if he chose this one, so how did he choose? Risk indifference curve. Okay? Risk indifference curve. The point of intersection. Four ka A. Yes, correct. Done. Good question. So this question, 3 questions I have tried to do in the morning only today. Okay, 3 questions. Good enough. Very good. Now look at this. You will have to answer this again. 3 questions I have done. Then we will come to ICI questions. Okay. It is a story of 2 companies called XYZ. It is okay. Only when you are wrong, you will come out. Now you have more clarity, Chandan. You have better clarity now, okay, exactly what it is, right? So you will focus more now. They are intricate, yes. It is a story of 2 companies called XYZ Limited. Tricked me twice, okay. It is a story of 2 companies called XYZ Limited and ABC. Be careful. XYZ A XYZ stock got a lot of backlash from investors due to its regular HR issues, bad corporate governance, poor internal systems, etc. And the investors shorted their stock and bought ABC Limited, which is in the same industry. Okay, now B. The stock of ABC Limited also faced certain issues like sales got severely hurt during Russia-Ukraine war, as a good portion of sales constituted exports to Ukraine. The stock price got affected, but it soon recovered as ABC soon identified a new market in Norway. Okay, XYZ is facing liquidity risk, systematic risk, unsystematic risk, or credit risk. Yes, please. So 3 questions I tried to create. Okay, I think they came out well actually. I'm happy. 1 ka C. Yes, very good. Unsystematic risk. Very good. And ABC is facing what? ABC is facing, उसका यूक्रेन वार का प्रॉब्लम है, वो सेव कर सकता है क्या खुद को? उसकी गलती है क्या? नहीं. Very good. Perfect. See how nice. So, कितने अच्छे questions बनाए मैंने, बोलो. Thank you, ma'am. करेक्ट, डन। अभी आ जाओ ICI क्वेश्चंस पे। कैलकुलेट द कोएफिशिएंट ऑफ वेरिएशन, नॉट वेरिएंस एक्चुअली, calculation of coefficient of variation depends on standard deviation, expected return. Guys, coefficient of variation का formula होता है sigma SD by mean. SD, oh, no, I was just joking. No need to thank actually. Just joking. Okay? Just joking, Baba, just joking. वन, यस, वन का डी आंसर। सब चेक कर लेना आंसर तुम्हें पहले ही। तो बेसिकली ए और बी दोनों आंसर ए भी होगा, बी भी होगा, सी, तो डी शुड बी द आंसर एक्चुअली, और देयर इज नो चॉइस अवेलेबल टू अस। यस, अकॉर्डिंग टू CAPM द इंटरसेप्ट ऑफ द सिक्योरिटी मार्केट लाइन शुड बी इक्वल टू, ओके, सो RE is equal to RF plus RM minus RF the whole into beta. Okay, so the equation of line is like this. The equation of line is like this: y is equal to a plus bx. And 2 का आंसर क्या होगा? According to CAPM, the intercept of security market line. So maybe like if I draw a diagram, guys, here, this is your security market line, SML. This is beta, and this is your RE, and this is your intercept. So what is your intercept? Naturally, the risk-free rate is your intercept. Yes. अरे C होगा, B क्यों आंसर दे रहे हो तुम लोग? True का आंसर will be C. The risk-free rate is your intercept in your CAPM model. 2 का आंसर will be C. So this is basically RF, na? This is RF. RF is your intercept. What is intercept? Intercept means from लाइन जहां से शुरू होगी ना, जहां से लाइन स्टार्ट होती है, उसको इंटरसेप्ट बोलते हैं। ये इंटरसेप्ट है, ये इंटरसेप्ट है। या 2 का C, yes. What is the common hypothesis for traditional and modern theories of portfolio management? Both approaches use statistical method. Both approaches are based on judgment. Both approaches are based on the hypothesis that portfolio. I think C should be the answer. कोई नहीं बेटा, कोई नहीं, इट्स ओके। हम लोग सिर्फ यहाँ ट्राई कर रहे हैं अच्छा करने का, इट्स ओके। गलत होने तो जितना होता है वो गलती तुमसे दोबारा नहीं होगी। यू विल नॉट कमिट द सेम मिस्टेक अगेन, इट्स ओके। नाउ थर्ड, what is a common, so what I remember is that both traditional and modern portfolio theory of Harry Markowitz say that diversification will reduce the risk. Okay, traditional theory did not focus on the relationship between the two stocks. मतलब मेरे कहने का, ट्रेडिशनल थियोरी ने सिर्फ क्या बोला कि भाई तुम एक में पैसा मत रखो, बहुत सारे में रखो, कितना डालना चाहिए, क्या रिलेशनशिप, ये सब बातें नहीं करी। तो 3 का C करेक्ट। Risk premium is extra rate of return expected by investors as reward for bearing extra risk. I think A should be the answer. 4 का आंसर A होएगा भाई। Yes, 4 का A. Arbitrage pricing theory was developed. मैंने नाम बोला था, तुमको याद है? मेरे जो बच्चे हैं उनको, मतलब मेरे बच्चे इन से, तुम सब मेरे ही बच्चे हो, अब तो हो गए, जो नहीं थे वो भी हो गए। All of you are like now, you belong to me. To a certain extent, of course, and who have done from me, so they belong 100%. But the name I have spoken again and again. 5th का answer, our APT model was done by whom? Harry Markowitz modern portfolio theory, capital market theory by William Sharpe, and APT model was done by whom? Yes, Stephen Ross. मैंने क्लास के नोट्स में लिखवाया है तुमको, स्टीफन रॉस का नाम याद है क्या तुमको? 5 का आंसर क्या होगा? स्टीफन रॉस। सो नाइसली डन गाइज, आई एम सो हैप्पी। अब मैं काम करती हूँ, इसको हाथ के हाथ ही लाइक क्विक शेयर। यस, वेरी गुड, एंड बाय बाय, थैंक यू। आई एम शेयरिंग दिस PDF in your telegram group, okay, because बाद में मैं भूल जाती हूँ। एक और करना है ना मुझे, एक और करना था, कौन सा वाला था? ये सिक्योरिटी वैल्यूएशन वाला करना था ना। क्विक शेयर, अब भी कर रही हूँ, देखो अभी सब कर रही हूँ. I will do all of them one shot only. Sorted? सामने सामने वो कर दिया. क्या क्या तुम्हारा टेक्नोलॉजी है देखो. All done. Both the sheet security valuation and portfolio management went on your Telegram group. Bye bye. Good night. No, सीधा Monday. Monday now. We'll do on Monday. Give me some break also, so I will be like comfortable doing the lectures. Like, you know, today is only 1st of March and we are already done with 6 chapters already. So almost quite like 40% over. So if you give me some time, because I have a lot of workload of CFA, then, you know, kind of other workload also. So this is comfortable for me. We'll meet on Monday with securitization. Okay? Thank you. Bye bye. Bye bye. Bye bye.